Hi everyone, it's Grant Abbott speaking. Welcome to part 2 of our Ethics, Professionalism and Best Interest as it applies to self-managed super funds. So today's actually going to be quite a busy session. So again, just feel free to use your chat facility or the Q&A forum as we go through. This is a I Love SMSF and LYD strategist and licensee session. So it's very small numbers, which is fantastic. Enables us to get a lot more involved if you want. Probably we'll be going through a bit of the legislation. We really need to start doing deep dives on a lot of these things and go and find out what the law is about rather than rely just simply on what this person or that lawyer or something, someone else says. But let's get into it. We're going to look through a case study today. So that will give us a bit of an idea how to apply things. We looked at this last week, but it's certainly worthwhile bringing in again. As I said before, the FASEA standards are out and they're pretty draconian and really they're going to get more so the deeper we get into operations. It's really its own legislative body and wields enormous power, and along with an increasingly aggressive ASIC and the ATO, the noose is getting tighter for all those who advise on SMSFs. And we get questions each and every day, you know, where's the line drawn? What can we do? What can we not do? And I'm going to be looking at that inside a case study today. In fact, we'll have a look at the case study. It'll show you how to either go in or go out either way. Ideally, SMSF should be treated in the same manner as discretionary trust. However, the Financial Reform Act, which in fact I did a complete book on way back in 2002, brought superannuation interests as defined as Section 10(1) of the SIS Act into the realm of financial products, even though there really is no underlying investment. So unless things change, we have to live with the consequences and also FASEA. As we said before, at least there's an extension of time for doing the exams, but I think the chord has already struck for many people, and really that the fact that they're going to have to upskill or do extra courses probably is it's probably a double-edged sword, because at the same time, where there's no commission to then go and do extra courses for fee for service really is quite a significant issue. So we need to work out, again, I'm going to revise over what is and what is not a financial product. We'll do that inside a case study rather than just look at the legislation. We will do a quick canvass of the legislation, but we'll have a look at that so that we know where the line is drawn and what we can and cannot do. Now, I'm looking at this from two angles. One is if you are a financial planner, you're licensed. I'll look at it from that regard and we'll look at the ins and outs on that. Secondly, I'm going to look at it from the fact if you're an accountant with who's got a tax agent's license, where you sit in that, so that we can start to draw our lines. So for the licensed advisors, obviously it's going to be useful, but the fee for service is going to have to expand. And you'll start to see a lot of the products and services, and more importantly, the strategy automations that we offer at like your docs is more non-licensed product. For example, wills, enduring powers of attorney, wills of testamentary trust, the protector, the moat, a new one we've got coming up, the moat and the castle. So a lot of these ones are really great fortifying solutions to give your clients certainty, security and safety around their family structures. And really doesn't involve any licensing issues at all. So two sides there is that one, it's great for accountants because you've got a lot of the data, and I'll talk about that a little bit later on. And secondly, even if your financial planner operates outside of your financial planning. So how that fits with your licensee is obviously going to be an issue, but it's certainly a great area to bring in a good, strong fee-for-service business. Anyway, let's go on and have a look at a bit of a case study, which again gives us an opportunity to apply the law. Again, last time we went through and we understood the law, we went through and reviewed the law. So read, understand, which we started to get into. Now we're applying the law, which is absolutely critical for any training standard. As we know, well, if you've been a trainer, essentially there's 4 standards of training or skills adaptation and adoption. Is we have our first level, which we call unconscious incompetence. That's essentially we don't know what we don't know, and we go around and try as much as we can. We read as much as we can, but the level of information we're getting is pretty crap. So we really don't know what we don't know. And I experienced that yesterday with a client, someone who'd sold a property, had a massive taxable gain, and working out ways to reduce it, which you can effectively by, and for example, if someone gets a big capital gain this year, so they're already up at that top marginal tax rate. First off, look at distributing down into, if they've got a family trust, distributing it into a self-managed super fund where it's taxed at 45%. So that gets rid of at least the Medicare and also the NDIS levy. Importantly, from that perspective, also, it's not going to be classified as contributions, just typically treated as earnings of the fund, because it is obviously a non-arm's length income. So if you're already at the top margin rate, why not put it inside the superannuation fund, and then it's going to be distributed according to wherever you just do it a proportion across all the investments of the fund. The members' allocation. So that's one way. If it's not from a family trust, so that's a good way. The second way is that usually, particularly this client who was retired, and that's not a bad deal, so they're going to be paying tax at the top rate of 47% this year. And effectively, next year, they would have virtually no tax because it's a once-off capital gain. So what you can do is you can use to a certain extent, you can use your contribution deductions. Remember, that goes over the cap. So we actually go over the cap. We put it into a contributions reserve in June of, say, this year. That will then float the excess contribution into July of the next financial year. Then it must be allocated in July. And when it's allocated at that point in time, it's treated as a concessional contribution, which is then added back to assessable income. But it's going to be added back to next year's assessable income. So it's a great little averaging provision. So you can reduce your tax liability down here and then flip it into the next year. We can take advantage of the lower rates of tax, the 42, the 30, and all those up until we get to 45. So that's a good little averaging rule. You know, it's not for everything, for everyone, but there will be instances where we can start to look at that, and just remember that in your mind as well, and also that family trust issue. Anyway, as I said, that the person that we're dealing with, he said, oh, look, I've been talking around all these people and some friends and all that, so you can imagine what sort of quality it is. And they've said that what we can do is effectively we can transfer the shares into a company, and then we can sell the shares of the company, so there won't be any capital gains tax or stamp duty, which is right. I mean, there won't be, if they sell the shares of the company, there won't be any capital gains tax or stamp duties. It was based in Victoria. The problem was to actually get the property into the company. Essentially, you'd be up for capital gains tax and stamp duty at that point in time. So again, there's a whole lot of these weird things. So he's unconsciously incompetent. The next level above is consciously incompetent, which is primarily, I would think, where a lot of people are in a whole range of tax and in superannuation legislation. And I must admit, one of the areas that I'm looking at the moment, I'm reading all the various succession acts and a succession book, which is essentially estate planning, family provisions, etc., to get myself up to speed there. I would gladly say that I'm probably now getting definitely consciously competent, certainly nowhere near the level of skill I have in terms of the SMSFs or perhaps the Corporations Act as applies to SMSFs. But when I first started going into here, I have had a lot of experience. There will be areas where we are essentially, it's like, oh my God, I thought I knew all this, but then you go to legislation and then you go to a couple of rulings, you think, oh my God, I don't know this. So you get that scary pit of the stomach feeling. You think about some of the past transactions you've done or advice, and think, oh my God, I might be exposed there. But again, that point in time is you either walk away or you embrace it, move on. So, for example, when we go to our 2-day workshop on the 23rd and 24th of March, which is now sold out. In fact, hopefully you've all got on to our investment strategy breakfast over the next few weeks, because I think apart from Adelaide and Brisbane and a couple of lunches which we had to put on extra, everything's been sold out. So with that one, what we have is we either drop out, or which is again a lot of plans, as I said, having to do extra exams are dropped out, or the next stage on from us is when we can consciously competent. So we sort of need to know that we can read, understand and apply the law, which is what we're basically doing here. And so we are pretty skilled at a fairly skilled level. Now, once you start delving into the law, in terms of the Australian qualifications framework, generally like a diploma is set at what, to give you an idea, is an AQF 6. If I'm working as an administrator and they're about to release a whole lot of standards, which I'm helping advise on for SMSF administrators, they're at an AQF level of 5. What we're doing here, applying the law as a set of facts, is around about an AQF level of 8, perhaps even higher. So it's certainly up at the highest level for us. So it gives you an idea that, one is that if you're doing CPD, and you certainly, if you're paying for it, you guys get it rolled into your packages anyway, but you want to make sure that you're getting the highest value as possible. Otherwise, all you're going to do is start looking at your mobile phones. So then you get to the top level, which is unconsciously competent. So, for example, I can think of a section, particularly in the SIS Act, and I can almost recite it. I know how to apply it, I know it inside and out, etc. So there I'm pretty unconsciously competent, but in some areas I'm consciously competent. But anyway, let's have a look at this. So John Smith approaches you to set up a self-managed super fund to buy $650,000 property from a client of yours who does property development. He attended a seminar of yours where he met the developer who sold him on an upcoming development, which is to be finished by May 2020. The developer normally pays a $10,000 referral fee, but you've chosen to rebate the fee for reduced costs for the client. The client has $400,000 in a retail super fund and a clean ATO history. You've set up the SMSF using light year docs, and you've set up a leading member SMSF with a leading member corporate trustee. So it's always good to start with the best right from the start. The client has entered into a contract in their own name, as the SMSF had not been established yet, but the developer's happy to change the name on the contract. So we've got a contract for the purchase of a property at $650,000. The client has capacity to borrow on the equity of their home to on-lend using an LRPA. So rather than going to a bank, they're happy to do a related party loan. So it's sort of a transaction that's going on each and every day across Australia with a few little variations. And we can look at it from a licensed point of view and an unlicensed point of view. Again, I'm not going to spend a lot of time on this because we did go through this last week. So if you haven't had a look at it, make sure you have a look at last week if you're coming to this fresh, but I'll go through some of the important ones. Then I'm going to look at a couple other important sections. So we know with the Corps Act, Part 3, essentially of the Corps Act, is consumer legislation. So where you're recommending a financial product, you've got to give the client enough, or the consumer, it actually says, enough information for them to make their own decisions. Now, we then had a look at section 763A, what a financial product is. And if you remember, that's where I give money to another person, and I call that money a contribution, but that's just the Corps Act. It's really crazy because shareholders are called members, contributions are monies given to someone else. So it gets a bit confusing under the superannuation law, but just understand when we're dealing with companies, shareholders are members, and contribution is classified as giving money to someone else in order for them to obtain a gain or propose to obtain a gain on that contribution. Now that would be a financial product, whether it's a managed investment scheme. And the other one, which is really important, is that there is no day-to-day operation or management of that particular investment. So, for example, remember a couple of the exceptions there were gold bullion. So that if I went up to you and said, look, gold bullion is the best thing ever, with the coronavirus, it's going to go through the roof, it's going to hit, $3,000, and I spruik it as much as I want, get on the internet and smash it out and all that. Effectively, I'm not going to get caught under the licensing arrangements of the Corporations Act. Now, there might be fair trade and, other consumer legislation around, but effectively, it's not a licensed product, because when I sell you or entice you to buy gold, you're going to end up with the day-to-day product. Now, if it was a gold ETF, that's completely different, because that contribution is going into an ETF which you have no control. In fact, many of the gold ETFs aren't actually backed by gold, but they're actually backed by swaps, futures and contracts. So you just got to be careful about that one. But that's the sort of difference. Property is exactly the same. So when a real estate agent says, look, this is a great investment property, you're going to get 7% yield for the next 2-3 years, and then, it's going to be dropping off back to 1 or 2%. They can do all that, and essentially it's not classified as a financial product, because at the end of the day, you are going to own that product. Whereas if you went into a real estate investment trust, that's completely different, because you're giving money to the trustee of the fund to invest on your behalf. So that's where the bifurcation sort of starts to split around a financial product. So with superannuation, it's sort of like, well, I'm giving money. If I look at a retail industry fund, I'm giving money to a trustee of a superannuation fund, and they're investing on my behalf. So it appears as though it's a financial product. For a self-managed super fund, it's the same sort of thing. Is it a financial product or not? I'm giving money to someone, they're going to invest on my behalf, blah, 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 etc. Now, with that one is that we could argue, because the trustees of the fund and the members, etc., are really giving the money themselves, and they do have day-to-day control as trustees of the fund. So ostensibly, you could argue that traditionally, under the financial product definition, effectively a self-managed super fund or creating an interest in a self-managed super fund is not a financial product. So the next one is, and I'm sure that the drafters of the law way back in 2001 looked at this and started to say, well, we've got to sort of clear this up. And you can see in section 764A, remember we had a look through there, there's about 2 or 3 pages of things that are what we call deemed financial products. One of those is 764A1G, and that basically says that any superannuation interest as defined in the SIS Act is classified as a financial product. And from there, we then went into the SIS Act and had a look under section 10.1 of the SIS Act. And essentially that said any beneficial interest of a member is classified as a superannuation interest. So ostensibly a trustee can never have a beneficial interest in a superannuation fund, because they're acting as a trustee, and you can't really be a trustee of your own beneficial interest. So it may be different if you're self-managed with a trustee and you've got the member, but the SIS Act just focuses in on your member's beneficial interest, because even though you're a trustee or a director of corporate trustee, when you look at it, it's not as trustee or director, it's as the member itself where you're looking at beneficial interest. So that then means that we end up with all these deemed financial products. So wherever a member has a beneficial interest in the fund, then in effect, this will be classified as a financial product or a deemed financial product, which means that an SMSF is potentially an umbrella of financial products for members of a SMSF, which, as we went through, we said it includes a contribution. So, for example, where we are rolling money over from the retail superannuation fund, if we recommend to a person to roll over money from a retail or an industry superannuation fund, effectively, then at that point in time, it's classified as a financial product, because the beneficial interest is making a contribution into a superannuation fund. Another one is obviously when we set up a self-managed super fund, the setting up itself is not a financial product, but getting a person to join a fund effectively creates a beneficial interest in the superannuation fund. being effectively, there's quite a few cases about that. It's virtually like a debtor-creditor relationship. So at some point in time, that a member can knock on the door of the trustee and then obtain their funds or use of their funds, whether it's a pension income stream, disability income stream, so on and so forth, which then leads us to the next level of effectively financial products, such as taking a lump sum. So if you recommended to someone to take a lump sum, financial product. Recommended them commence a pension, financial product, because you're creating a beneficial interest, if that makes sense. As I said before, the T-bar issue, I think, probably has created, I think it's probably a lot of people should be looking over their shoulders for that one, because the rolling back of excess pension amounts over and above the 1.6 million T-bar at 30 June 2017 back to the accumulation is in itself a financial product, because you're commuting that pension, whether you roll it back or take it out, it's still effectively a financial product. And if you're licensed, you need to obviously do a statement of advice around it. If you were unlicensed, then obviously you've breached the Corporations Act. We had a look at binding death benefits nominations and more importantly, SMSF wills, which if you've been through our strategy sessions on SMSF wills, effectively what we've got there is we've got a position that really these are contingent entitlements, because, for example, someone might withdraw all their money before they die, so BDBN means nothing. So in that instance, you are sort of contingently dealing with a financial product, but there is no immediate action. So I would say that doing a BDBN or SMSF will effectively is not a financial product. Now, if you do a pension which has an auto-reversionary pension, then that clearly is a financial product. We went down and had a look at some important exclusions, which I want to look at. We looked at superannuation interest and we look at best interest and all that sort of stuff. So I'm just going to bounce out of here. We're going to then go and look at the legislation. We won't look at CIS, we'll look at the Corps Act. For that one, I want to look at first section 766B5. We looked at that, but I think this is a pretty important one for us. And I am going to be using this case study at the two-day event. So I'll flesh it out with kids and more family members, etc. So we cover it off. And remember, all I'm doing now is, when you look at the compliance flywheel that we have to deal with when we're in an SMSF, we look at the trust. For those of you who've been with me for a while, we'll look at the trustee first and make sure the governing rules of the fund comply with the relevant requirements. We then go and have a look at the Corporations Act, which is, do we need to be licensed to give advice, or do we not need to be licensed to give advice around this or making a recommendation? We then go on to the CIS Act. How is it impacted by the CIS Act? We then move on to the Tax Act. So that's our fourth limb of the five-limb rule. And then finally, once we do have that transaction, we then start to build the documentation on the Light Year Ducks platform to ensure that it all sticks together. So that's the five set compliance wheel. I mean, you've got little subsets of that, such as family law, bankruptcy act, so on and so forth, but that's not really an issue for us. So what we want to do is go down to section 766B, which talks about giving financial advice. So if I just go down, I'll just go to the top of that, so you know, then I'm going to come down to the exemptions. So what it says here, for the purpose of this chapter, financial product advice means a recommendation or a statement of opinion. So that's pretty broad and can be really offhand comments, or report or either of those things that is intended to influence a person or persons in making a decision in relation to a particular financial product or class of financial products, or an interest in a particular financial product or financial products, or could reasonably be regarded as being intended to have such an influence. So then we end up with general and personal advice, which I won't go into, but just be wary. For example, at the moment I'm giving you general advice, believe it or not, around the case study, and it's certainly not specific financial product advice. But if I start looking at a real client, then we'll be caught in there. You can see here, 2 is personal advice, general advice. General advice is financial product advice, it's not personal advice. So for the purpose of this chapter, personal advice is financial advice given or directed to a person in circumstances where the provided advice has considered one or more of the person's objectives, financial situation and needs, or should have expected to. So what I'm doing is I'm not doing any of your requirements. So potentially I'm giving you general advice there, and then there's a lot of exemptions. Now, remember we had a look at these exemptions before, and I am doing a session tomorrow morning with Tony and Willis from Abbott-Family. If you can come along, it's a 10 o'clock session about how we as lawyers work with you to effectively increase your offering and also potentially make a lot more fees. So how we work alongside our light year docs users and particularly our ILS users and licensees. Now, the benefit there is that when we give advice, effectively, we might do a letter of advice, verbal advice, etc. We do that through the firm Abbott-Family. And so we can then use A and B, which is looking at the legal interpretation or the application of the law, so on and so forth. And that would then mean we're effectively exempt from financial product advice because we're not giving financial product advice. Again, except as may be prescribed by the regulations, advice given by a registered tax agent or BAS agent that is given in the ordinary course of activities of such an agent and that is reasonably regarded as a necessary part of those activities. So, for example, if a client is, if you're looking at a client for year end, and you're talking about tax deductions and contributions and going over the caps, etc., and you frame it in a taxable way, so from that perspective, you can rely on this exemption for financial product advice. However, if you do so, you do want to rely on that, you still need to tell the client that they may need to go and seek, it's up to them whether they want to seek financial planning advice around that. So this tax agent advice is quite extensive, and I will be going through that on the 23rd and 24th of March in quite detail and looking at a couple of asset requirements there. So for that, the other one I wanted to have a bit of a look at is, let me just get up I think I have on this slide. Jump up. No, I didn't on the next one. Okay, so what I want to do is 911A to J. So again, I couldn't remember the exact section. I knew the sections around 911 to A. So we're getting there. 908. Now, thank goodness I don't know all of these sections. That'd be so boring. Okay, but I do know the right ones. So, okay, licensing of providers of financial services, which is important. So we go down and, you know, who's got to be licensed and blah, 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 blah. What we're looking for is exemptions. So if I go down to 911A2, don't freeze on me. There we go. 911A, the need for a financial services license. Now, when I go down there, you see, subject to this section, a person who carries on a financial services business, which essentially is the provision of advice around a financial product, and we've done all that stuff. We know if you've got personal advice, then you're carrying on a financial services business. So again, we looked at that in the last section. So you must have a license. I won't go into authorised reps, that comes down later. But we've got two, however, a person exempt from the requirement to hold an Australian financial service licence for financial services they provide in the following circumstances. So here comes the first one. The person provides a service as a representative of a second person who carries on a financial service business and who holds an AFSL that covers the service or is exempt. So that's authorised representatives don't need to hold a licence, but then they've got to work in under the licensee, which many of you may well be doing. What we want to do is just go down to J, so EF, we will get there. So GHIJ. The person provides a service and the person in capacity is a trustee of a self-managed super fund, which is good. So, for example, if a director or corporate trustee, if they're telling their members, their kids or the parents or whatever to start a pension or do a trust or do whatever, they'll never ever be caught under the under the Corporations Act, so they're completely exempt. They may go out and, you know, say to all the members, have a directors meeting, particularly if you're doing a leading member corporate trustee, where effectively the leading member has the power to veto all the decisions or make investment decisions on behalf of the fund. That veto power, there can't be any complaint under the Corporations Act if they decide to invest in, say, gold ETFs or whatever. Because again, the gold ETF is a financial product. But again, if we have a look at it, the trustee of a self-managed super fund is exempt. Trustee of a retail or industry fund, absolutely not exempt from that perspective. So let's go back and have a look at the financial products that we've got here, because I need to have a look at that. We then need to say, well, where that fits in. Then I need to have a look at the ethics and professionalism standards, have a look at each of those. So we can only look at that in terms of, one, what is core and what is not core. So if I recommend to set up a self-managed superannuation fund to a client, then quite clearly, and then obviously take money over from a retail fund or industry fund, quite clearly that is a financial product. So what I've got to do there is, you know, I have to give them the financial services guide that covers SMSFs, and more importantly, that I have to do a statement of advice around that. Now, we are working on that to provide, it's going to be probably hopefully in the second quarter of this calendar year, maybe the third quarter, a statement of advice solution only around self-managed super funds. So it's not going to be any investment modelling, etc. It's just going to cover really tight areas like this. The only issue that we have is generally our SOAs will be perfect for those of you who have your own licence, absolutely perfect for those of you who have a limited licence. So accountants will be able to use the SOAs because it just focuses in on the general contribution and also the establishment or membership. Remember, we're only dealing with members of the SMSF, so it'll apply there. But remember, in this instance, we had the client coming to the accountant and saying they want to set up a self-managed superannuation fund. Now, in that instance, if they set up if they're acting at the direction of the client, what I am going to do is I am going to do a letter whereby the client will sign the letter noting that they're getting the accountant, or more importantly, I'd be using the tax agent there, the tax agent exemption, because mostly fit there. You're getting them to, they are getting you to set up the SMSF, and I'll talk about contributions a little while later. So you set up the SMSF and also advise on any tax consequences therein, but obviously there's not a huge amount there. And then from that perspective is that will give you an indemnity and coverage. Now, you can't guarantee that is going to be the case, but it's absolutely vital for you to obtain advice from the client in relation to the fact that they want you to set up the self-managed superannuation fund for them. Then you're simply acting at their directions. And if you then broach it in under section 761B5, is 761 or 76B? So I think it's 766B5, so sorry about that. Then you're going to be in a pretty good position. Now, the withdrawal from the retail superannuation fund, obviously, again, we've canvassed that. If you're licensed, that's just part and parcel of the course. It's not so bad. You've got to cover insurances as well, but I know that a lot of the opt-in now measures apply, and a lot of people are losing their insurance anyway. So it's not the insurance option should be covered for both in and outside the fund. And it's worthwhile anyway, if you're looking at investment strategy of the fund, to cover insurances for the client and let them make a decision. From the ordinary accountant, we've talked about the first one where the licensing fits in if you're doing the directions, but no way should you be telling them to take contributions out from the fund. But if they ask you about contributions going or setting up the fund. They're saying, well, we need money to set up the fund. And then they're said to do rollovers, let them do the rollover process there for them. Or alternatively, work with a financial planner or someone who's licensed. So many of you are accountants, so you're tied with a planner or an advisor, and then essentially work from there. Now, this is where we get a bit of fun. So they're going to go and buy a property from a developer, and as I said before, effectively that's not a financial product, which is actually not so bad for the accountant, but you're not giving advice around the property anyway. You certainly give around the tax consequences you need to get. If it's a brand new property, you talk about capital allowances, depreciation, gearing expenses, how that will throw up deductions in the fund. We need to make contributions into the fund in order to soak up those losses or the tax deductions. So you can get involved there, and remember, it doesn't matter what happens, you're definitely falling in that 911A 2J, the tax advice, because that's right in your normal course of business. Now, the reverse side is for the financial planners. We talk about setting up the fund and contributions. A lot of licensees aren't really keen on you advising around property, etc., because it's not a financial product. And then so they don't want to take that responsibility. So it's not a bad idea where you have your lines drawn inside your firm, and you know which part is accounting, which part is financial planning. Bearing in mind, if you're concerned about anything, you can always come to Abbott-Family. We'll be going through this exercise tomorrow in our session. If you haven't booked in, just jump onto the LYD website and book in for tomorrow's session. But we'll be going through that tomorrow and looking at how we can work closely there with you to take that responsibility if you so desire. So we do that now with the investment strategy. Obviously, we're going to go in and have to do the investment strategy, and I've done so many of those. And again, we'll look at this next week in terms of building investment strategies for the fund at the free breakfast or lunch section. So make sure you go to those. I'll show you where you can access those a little bit later on. So for that one, remember we go back to giving money or money's worth. So even if you advise the trustee on property, we know that's not a financial product, doing an investment strategy. Now, doing an investment strategy, I'm not giving contributions or money's worth to anyone for the investment strategy. We're simply recording what the future asset allocation of the fund is, and that's quite apparent. So as long as we don't go down and say, well, our future asset allocation includes us buying the property, we could say, because it's not a financial product, but buying gold ETFs. As soon as we do that, then if the investment strategy actually goes into specific products, that's where you potentially get caught under the financial products under the Corporations Act. Whereas if we have a look at it from this perspective, we're in a pretty good position. If we're just doing asset allocations or doing investment strategy, you don't need to be licensing, because remember, we have to get in under the general rules of giving contribution or money's worth, because dealing with the beneficial interest in the superannuation fund does not apply to the trustee of the fund. So we're sort of looking at, up and above that. So investment strategies, I'm pretty comfortable. That's not cool. LRBA is a loan, so that is not classified as a financial product, nor is obviously a related party loan over an LRBA. They did try to make it, deem it to be a financial product going back in 2008, but the regulations never saw the light of day. So again, for those of you who are accountants, you can do it to the cows come home. Just be careful though. If you are licensed, you may want to flick it over to the accounting side. Now, we're doing a related party loan. It means that obviously monies are going to go from the individual into the superannuation fund, and there'll be a payback at some point in time, particularly if you're using the Commissioner's guidelines, and that's all built into our strategy automation, which I'll cover a little bit later on. But what we need to do is, if you're going down that track, you need to put in place an SMSF will. So that is, there's an outstanding loan. So if someone dies, is that loan attributable to the person who's died, or is it part, or it's just kept inside the fund? And then we need to work out what happens from the other side of the equation, is if there's a loan to a SMSF, and that sits inside the estate of the individual or deceased testator, then obviously we have to work out what the executive's going to do there. So I think we just need to work out there is you'd want to do at least, if you're going through this process, shortly thereafter, you want to be doing an SMSF will and a corresponding will and potentially a TT, and maybe look at the loan documents, including a forgiveness clause or doing a gifting clause attached to it for that point of view. So that's sort of where we want to go. Now, I want to just jump quickly to FASEA and the Code of Ethics here. So this commences on the 1st of January 2020. We'll just go through and have a look at our case study and how it applies. So I'll just get my little bouncer so we can have a look at where we're going. So my wee spotlight. Oh. So compliance with the Code of Ethics is a requirement for all financial advisors from the 1st of January 2020. Now remember, we don't have to worry about this necessarily if we are an accountant. The code issued by FASEA is a set of principles and core values that lays the foundations for a true profession to emerge. It's a principles-based model providing a powerful framework to shape and reinforce ethical conduct and encourage a deeper engagement by the individual with their duties to their client, as well as a wider society. As such, those who formerly provided commercial service are now committed to offering a professional service informed by a code of ethics that intended to shape every aspect of their professional conduct, which scares me. Now, this is why FASEA is important. This code and the standards with it are a matter of legal obligation. So when they put these standards down, it actually becomes what we call delegated legislation. The Parliament has given FASEA the power to make legislation in its own right. So, for example, we looked at how a bill, once it goes through both houses of Parliament, then becomes an act and that becomes law once you've received royal assent. From that, then there's regulations which have to sit for 10 days on both houses of Parliament, the Senate and the House of Reps, before becoming law. And then, of course, there's delegated legislation, which is what we've got here. So this code and standards are legal obligation, provide a foundation for conduct, whatever their employment circumstance. So let's have a look at the standards. So standard 1, you must act in accordance with all applicable laws, including this code, and not try to avoid or circumvent their intent. So in that one, we have to be very careful about what is a financial product and what is not. We don't necessarily want to push it too far, because remember, ASIC has got a pretty big stick, and they'll be the ones who will obviously be enforcing the relevant standards here. I'm not aware that FASEA has a legal division as yet. It may well down the track. So we've just got to make sure that we look at the Corporations Act as we did. We look at what is a financial product. We then look around our statement of advice obligations, our best interest obligations, which we'll look at a little bit later on. And then more importantly, we then have to look at this code, because this is an extraordinary piece of delegated legislation. So you must act with integrity in the best interests of each of your clients. Again, if we go back and have a look at our case study here, I'll just pull it up and we have a look at here. We've got a $650,000 property. Now, if you're a financial planner and you're getting a $10,000 referral fee, then effectively, you've just got to be very careful about that, because that would be classified as potentially a best interest issue that you've got to be careful about. When we go down from that, they have pinged a couple of people about setting up SMSFs because they were saying it was not in the best interest of the clients. Again, I think it's important that when we do go through that process, I'm going to show you the 4-step process very shortly, that when we go through that process, that the client needs to be fully aware of why and when they're setting this up. Now, if they've come to you and they desperately want the property, and then you provide enough information around moving from where they are to they're here, then quite clearly you shouldn't have a problem with best interest. If you took a $10,000 referral fee, obviously you're going to have problems. Now, you must not advise, refer or act in any other manner where you have a conflict of interest or duty. Potentially, the issue we've got here is that the client of yours is the property developer, and then another client is investing in them. Now, if you were the property developer investing in you, quite clearly there's a huge conflict of interest there. But certainly there's a potential issue there because they are a client of yours. It depends if they're giving you quite significant fees around the property development and ongoing fees for managing the development or managing the capital raise or whatever. You've just got to be really careful about that as a conflict of interest, because they do start to look inherently beyond the first obvious and down to the second. So you just got to be careful there. But as I said, if you're an accountant, you're probably not. If it's not a financial product, it's not a big issue there. Standard 4, you may act for a client only with a client's free, prior, and informed consent. If required in the case of existing client, the consent should be obtained as soon as practicable after the code commences. Actually, just going back on this one, it's very interesting where Australian Super provides 20,000 Qantas points for someone who rolls over to their superannuation fund. I would have thought somewhere along here, quite clear they've probably breached the code. But remember, this code applies to those who provide financial product advice. Not necessarily the trustees of the fund, but I could probably extend it to there if I wanted to. Standard 5, all advice and financial product recommendations that you give to a client must be in the best interest of the client and appropriate to the client's individual circumstances. You must be satisfied the client understands your advice and the benefits, costs and risks of financial products that you recommend. You must have reasonable grounds to be satisfied. Now that produces a bit of an interest there, because if we have a look at the ASIC, if you've seen the ASIC flyer, I'd pull it up now, I'm just running out of time. The ASIC flyer around how running an SMSF takes 100 hours and you need to have like more than $500,000 and it's going to cost a whole lot. That's from that perspective, if you sort of stuck between a rock and a hard place, because if you don't give the client that, it's worthwhile giving the client that and then saying, look, but our estimates for clients are blah. And it wouldn't be bad to get a couple of testimonials or written letters from existing clients as to the amount of time they spend on SMSF, so on and so forth. Because otherwise, you're sort of stuck if you don't show them that ASIC letter. ASIC wrongfully is sending that letter out to clients anyway. So just be careful around that one. You must ensure that your records of clients, including former clients, are kept in a form that is complete and accurate. I think that's pretty important. And if you're licensed, or you're a licensee, they're going to do that anyway. Standard 9, all advice you give and all products you recommend to a client must be offered in good faith, with competence, and be neither misleading nor deceptive, which a lot of that really comes under best interest anyway. So that's quality process. We looked at client care, ethical behaviour. Now we're jumping on to professional commitment, which is important. You must develop, maintain and apply a high level of relevant knowledge and skills. And for that, remember we went through the, in fact, I might just, let me just see if I can bounce out of here. Oh, sorry about that. I'll just go up here and I'll get the URL. And I'll put that into a new little, and then what we'll do is, remember we had a look at this, these standards. So we had a look at continuing professional development. Again, this is the law, and remember from the 1st of July, naming and shaming goes. I showed you on the side, I'm not sure if I did show you through this, but these are essentially the standards. You need to have technical of 5 hours. So there's 40 hours of CPD, 70% must be approved by their licensee. So if you're doing our stuff, make sure they are approved by your licensee, or contact Ash at, so that's ash@ilovesmsf.com to ask, or at least get us in control with your licensee. We can go through our quality standards. So you've got 4 hours of reading, so that means you have to have 36 hours a year. Now, when we have a look at that, 5 of that is technical. So that's nothing. I mean, all of us have got technical. Every time you listen to a lot of my stuff, it's technical. This is not technical. This is professionalism and ethics. So client care and practice, 5 hours. Regulatory compliance and consumer protection, 5 hours. Professionalism and ethics, 9 hours. So these are the big ones, 5, 10, 19 hours out of 36 are effectively, so that's well and truly over half, must be in these 3 other areas. The balance of up to 40 hours must consist of qualifying CPD. So you can have, for example, there 19, 24, going up to 36. So the other 12 can be technical if you want. But essentially, you must have these ones as a minimum, which is why we've done this professionalism and ethics over a 2-hour slot in order to help you out. So if I just go back to Code of Ethics, we looked at this before. So you must develop, maintain. So the danger about that is that if you don't meet these standards by 30 June, you will be posted up on the ASIC website as someone who hasn't maintained, or hasn't met standard 10. So you've got to be careful. Standard 11, you must cooperate with ASIC and monitoring bodies in the investigation of a breach or potential breach of conflict. And standard 12, individually in cooperation with peers, you must uphold and promote the ethical standards of the profession and hold each other accountable for the protection of the public interest. So there we go. And then, of course, the values are trustworthy, competency, honesty, fairness, and diligence. So when you have a look at that, that's quite a hardcore. They are legal standards. And as I said before, it's something that we've got to be really careful about in our day-to-day operation. So going back to our FASEA and ethics standards, so we've had a look at this. We looked at in terms of the SMSFs. So I've covered where it fits in with best interests. Obviously, CPD, if you're giving SMSF advice, you need to be structured towards that SMSF. It is only SMSF. Certainly for limited licence accountants, 40 hours of CPD would have to be focused pretty heavily on the application, for example, client care, etc., as the Corporations Act applies to SMSFs. One of the things I will be doing coming back probably around about June, I'll be doing some CAT courses for those people who need their CPD. So, but make sure that you do cover your requirements and keep your records. We send out quarterly records for you. So just tally up what you've got up until 31st of March. That'll come out in April, and see where you're short, and then start to work pretty hard on that. So let's go and have a look at what happens legally and client-wise. First, step 1, what I'll be doing is a declaration of trust. So the SMSF, the property is in the name of the individual. So I do a declaration of trust, and you can get that straight off the LYD website. And that would at least hold you over until the new contract, because just because a developer says that they'll do a new contract, it doesn't mean it's the case, because you can find that new contract, when they go to the lawyers, they'll charge like $3,000 to $4,000 for. So do a declaration of trust there. Obviously, once you've set up the SMSF through the Light Year document, we're doing leading member with leading corporate trustee, send in the ABN, but you're going to find now, as of right, that there's a twofold process there, is that the ABN TFN is going to take 28 days as a minimum. I haven't heard anyone, in fact, I understand it's even getting longer than that, but the tax office will ring your client. So you need to have a session that when you do it in an SMSF, and I think it's important anyway, as part of the process before they enter into an SMSF under the relevant standards, to explain to the client that you are dealing with ATO and also ASIC, and that the ATO are going to want to know why you set up the self-managed super fund, who the advisor to the fund is, did the advisor recommend the SMSF to you. So in that one, if you're not, remember, if you're using the tax agent exemption, you say, well, no, it's I asked my accountant to set up, my tax agent to set up. They'll want to know property, investment strategy, sole purpose test, and who else is involved in the transaction, for example, a developer, etc. So they'll be asking, did the developer tell you to set up a self-managed super fund? Did they tell you money to come from a retail industry fund? So that they're getting quite brutal these days, and anyone who's been dealing in the tax office, there's certainly been a big change of the way they are operating now. So what we're going to do is just get our client in that mind frame. Step 3, use your RPL, the strategy automation, which is sitting on the Lightyear Docs site. And effectively, that's only going to take you 15 to 20 minutes to basically do that whole loan with mortgage, building the LRBA, so on and so forth. If you haven't seen that, go and have a look at the webinars under our support centre. Go and have a look. I think it was probably around about maybe July of last year that I did the RPL for property. We've got both RPL, which is the related party loan for both property, and we've got ones for shares as well. And as I said, finally, what you would use is the moat for an EPOA, SMSF, and will with or without TT. So I'll come out and look at that later on. But look, the moat to me is probably one of our best. Look, everyone should be doing this anyway. It's just absolutely crucial for your clients because it's a really great process. But we'll talk more about that tomorrow in our session with Tony from Abbott-Family. So let's just go through, and I want to finish on the hour. It's gone so quickly. See if you can get into the I Love SMSF breakfast. So for that, you can just go on. And you can see here, you can access it through I Love SMSF. If you go to I Love SMSF, you'll see there's a button under events for the investment strategy webinar. So there's a lot of stuff on there. It's going to be really good. I'm going to go into some of my top strategies. We're going to be looking at what you really need to do given the Commissioner's guidelines around investment strategies, which we have been through before. So this is the investment guidance we had a look at. So we're going to go through the Commissioner's guidelines on that one. And then effectively what we'll do from that perspective is we will pull it apart, show exactly what needs to go, why it's not a financial product, so on and so forth. So see if you can squeeze in there. As I said, a lot of the breakfasts are finished. But Sydney, we've got overflow lunch sessions, which isn't a bad thing anyway. Perth, we've just opened up the space for another 10. Adelaide, I think we've got about another 5 to go. Brisbane, there's another 10. I don't know what happened in Brisbane. And then that's about it. Everything else is sold out. So jump on if you can. We're not doing any more marketing from it because we know that it's going to be fully subscribed. On the 17th of March, I'm going to be launching to everyone the Protector. If you're not using the Protector, it's just do it for yourself, particularly those who are on subscription. Just do it yourself. Go through the process. Go on and have a look at. Sorry about that. Go on and have a look. Sorry about that. Go on and have a look on our support centre for the letter for the Protector. Then also from that, go and do the Protector for yourself. It's a great way of, it's quite a sophisticated transaction. It just takes about 10 or 15 minutes for you to do, but effectively it gets rid of all the equity you have in existing assets, transfers them into a bloodline trust or what we call a leading member trust, which means that if you get sued or particularly if you die and under a family provisions claim you've got nothing, then effectively it's all basically sitting in this separate vehicle, which really lasts for your bloodline and can run into perpetuity if you've set it up in South Australia. So watch out for that, 17th of March. I will be doing a breakfast session in Brisbane on that day, but I'll still be doing down that, and I'll be doing that with Tim Munro. So watch out for that. I haven't opened it up, that'll be shortly. 23rd, 24th of March, Succession, Asset Protection, Estate Planning. Sorry, it's sold out, but the recording will be available. So you can go onto the site and get that. And again, just finally, just make sure you keep up to date with CPD. Don't leave to the last minute. So if you watch the last session of this session, you've got 2 FASEA hours. Now, I hope to see you at the upcoming sessions, investment strategy sessions, or for those of you coming to the workshop, that'll be great. If not, I've got a whole lot of sessions which will be announced in a couple of weeks in May. So it'll be a full day session on succession, asset protection, estate planning. So that will definitely be worthwhile going to. We'll be going through so much there. So we're moving now from just really just building docs, which we spent the first few months doing, to now really build full-blown strategies that are really done for you with client instructional, educational material, EDMs, etc. there for you. So it's going to be pretty exciting. Anyway, that's enough for me. We're now up at the hour. So thank you very much for attending, and this will be available for you later on today.